Hey guys, welcome to Trading with Dan's School of Trading. I'm your host Dan. Nice to meet you all. So today we are going to look at the 50 period moving average. So first off, we're going to go over what the moving average is and how to get it up on TradingView. So you can see here we've just got the just a chart of Bitcoin here for the last couple of years. So we're gonna put on a simple moving average. So what you do is you go to the indicator tool here, and then you will type in moving average, or just start typing it and it'll come up. So this is the one here, moving average. So you would click on that and then it'll come up onto your trading view, onto your chart, and then the settings we're going to use for the 50 period, we'll click on it and then obviously typing 50 there. And then click OK. So then we can see what we now have on the chart is the 50-day moving average. So you can kind of see from this chart that the 50 period moving average, the 50-day, I call it 50 period because it is a 50 period moving average, but if you look at it on the day chart, the daily chart, then it is going to be the period of that chart is daily, so it will be the daily 50 moving average, so the 50 day moving average. So what it is an average of the previous 50 days closes divided by 50, and that will be where it will be plotted, basically where the line will be plotted on that day, and then obviously they're joined together as you go over through the days to produce a curve here, which you can see. So I mean, you can already see the significance here on the Bitcoin chart. We were in the uptrend when the 50 period moving average is moving upwards, so we've got an upward slope. We don't necessarily get supported exactly on it, but you can see it kind of moves up with the price, and we do get supported sometimes like exactly at it, or we can break below it and then in not too long move back above it again when we are in a bull trend and we have an upward slope. And then you can see when we concisely broke the 50 period moving average, the 50-day moving average in Bitcoin, we stayed under for a more prolonged period and got away from it, and the slope then also started to come down. We can see we then entered a bear trend. So you can see in this bear trend, and obviously we would then often come back up, maybe test over it, but often get rejected, especially which you will especially see happen in price action when the slope of the moving average is down. So when the slope is up, you will find you'll either be supported or you won't spend too long underneath the moving average when you're in a bull trend and the slope is up. And then when you're in a bear trend and the slope is down, you will often find you don't spend too long above the moving average before you get then forced back underneath the average, and you resume the downtrend, as you can see happened here in Bitcoin. And obviously you can see we had the capitulation in Bitcoin here at 6,000, where we then again moved under the average, and as you can see here, the moving average did catch all the way up to round about where the price was, and you can see that in effect forced the price down because we were still in a bear trend. So we had our capitulation. We then regained the moving average, we gently rose up with the slope. The slope started to go up, and then we entered our bull trend, this 2019 bull trend. You can see we then in a way we rode the average up. I mean, we never actually touched it. We were in a pretty strong trend, as also was signified by the slope of the moving average showed that we were in a strong trend. So you can see the stronger the trend is, the less likely you are to actually touch it before then resuming the uptrend. So you can see in this latter part of the trend here, we didn't really get very close to the moving average until we started to lose steam. But in the early part of the trend, you can see we did have quite a bit of contact with the moving average. So as we can see the same here, we had some more contact here than we did here. And then obviously the move started to lose steam. We eventually got the negative slope in the 50 period moving average, the 50-day moving average on Bitcoin. It then did, we did struggle to stay above, and price was forced down. So as it stands now, as you can see, we are above the 50 period moving average. The slope is now upwards, so this could potentially be the start of another bull run in Bitcoin. But that isn't the point of this video now, and you may be watching this a long time after I did the video, so you will obviously know what did or didn't happen here. My point more is not current Bitcoin analysis. It is just to show you how we use the 50 period moving average. So yeah, we can also use it in conjunction with a 200 period moving average. So what you have here is an average of the price over the previous 200 days. As you can see, this obviously moves slower because each new day will only contribute 1/200th to the actual price, the actual position of this average, the actual value of it. Whereas in the 50 period moving average, each new day contributes a 1/50th. I know obviously 1/50th is smaller and 1/200th is small, but 1/50th is still 4 times larger. So the price will obviously move 4 times quicker with the new incoming daily data. So yeah, so that is the simple moving average. But what is actually a more potentially a more valuable average to use if we get rid of these is what we call the exponential moving average. So this again, we can go into our indicators here on TradingView, start typing in exponential. I mean, that will get it on here, moving average exponential. So this, if you click on that, then it will then bring up one of these, EMA, an exponential moving average. So what an exponential moving average is on a 50 period and how it differs to a simple moving average is simply the fact that an exponential moving average will take in more relevance basically to the data that is more recent. So the last, say, like the last 10 days of a 50 moving average, the price that the asset was at, in this case Bitcoin, will have a higher weighting in where the higher weighting for calculating where the line will be than the first like say 10 days of data that was like 40 days ago to 50 days ago. So if you understand what I mean, so it's more heavily weighted to more recent data. So what this will mean is that it will react quicker to price movements because it is more heavily weighted to the more recent data, whereas a simple moving average just has an even weighting from 50 days worth of data. So I mean, we can compare them if we click them both on here, so we can see the price. The red line will usually be closer to the price direction, the direction the price is going at any given time. So see, as we start to move up here, the exponential red line moves up quicker than the green one. As we start to move down here, the exponential red one is moving quicker and closer to the price than the green one. So you'll be able to see generally in an uptrend, the red line will be going up quicker, and in a downtrend, the red line will be going down quicker than the simple moving average. And it is marginal, the difference on a 50 period between the exponential, as you can see, especially if you're in a sideways market. It's not going to matter so much the weighting over that 50 days if all the data is relatively the same, relatively similar. But if I get rid of, sorry, the 50 period, sorry, not that one. If I get rid of the 50-day simple moving average, I mean, yeah, so you can see we get our similar touches on the price, and then we'll move down quicker. So the slope, it will start sloping quicker than it would on the simple, and but it generally has the same sort of effect, not effect, but it basically has the same gives you the same signals on where the asset is pretty much going. So with a downward slope, you will often get resisted by it and forced back down, but you can see we do get the upward slope here. So you can see if you ignored everything to the left of the curve, sorry, the right of the curve, you can see price started going up and the average started curling up, and you could see that's potentially bullish. and that did move quicker. If we put on the simple moving average again for you to see that was still moving down and only really started to slightly move up. But you can see how that is quite similar to what we've got here. And again, this isn't a Bitcoin price analysis video, but you can see that we are getting a move up in the simple moving average in the price. But obviously you can see what happened there, and we don't know what's going to happen here, but that is potentially one of the outcomes if you look at that fractal. But yeah, so that very basically is that's very basically giving you an overview of what the moving averages are. So yeah, so we're going to have a look again at a different asset here, not Bitcoin. We're going to look at Intel. So looking at Intel back in 2013, 2014. So you can see what we have on here is a classic cup and handle playing out. So you get that this is the cup and this is the handle. So what happens is we are sort of going up, being led up with a rising 50-day exponential moving average. We obviously get we get some moves below, but they're picked up after a certain amount of time. We get some moves below that are then picked up again, and then we do get a sort of a blow off top here, away from quite a bit of a distance away from the 50 period moving average, and we do also get this is a reversal candle. This is a doji candle, but we'll cover that in a different video, a video on candlestick analysis. But this is the doji candle, so that often will signify the top or the bottom of a market, depending on whether it's going up or down and the shape of that candle. But yeah, so we then obviously start to come down. We then break under like we have done a few times here, but this time instead of regaining the 50 period moving average, and also you may notice we were starting to slope down a bit as well. We actually did lose. We actually lost the support there. So then that did obviously trigger a lot of stops that people would have had around about here, because you can see if you're trading this asset in it's going up, you've got generally speaking a rising 50 period moving average. You've seen twice before price get picked up just below. So as you get in this price action here, you're not stopping out of your trade yet, but then obviously when we do get quite a bit far, and then this is obviously all the stops getting taken out, but this does look like a pretty savage stop hunt, because what people will use nowadays more so with high frequency trading and the bots and how a lot of trading is done, you'll get what are called stop hunts. So people know that people are looking at these moving averages, so they are looking at this and saying, right, if we break below, we can trigger some stops. People will sell into the market. We can then buy that market back up again, and then make some money, and obviously at the expense of the people that sold out underneath. I mean, this happened here, and then yeah, so on here they did actually capitulate the stops to people that bought here thinking we'll go back up. But what did happen, we did after that flush out of the stops, sort of a stop run a few days, we did regain the 50 period moving average. We consolidated around it, and then we broke off it again, and as you can see, we broke off. We formed the right hand side of this cup formation, and yeah, and then price did rally a bit. We rallied up again, and then what you can see is this is how a cup and handle, partly one of the ways a cup and handle is formed, like the actual sort of under the hood of it, is that we then we had a bit of an extended run, diverging away from the 50 period moving average, and then we then came back, tested the moving average. This is called a tweezer bottom, tweezer top bottom, tweezer top, tweezer candles. So we did break below, and then we got back up, and then we did actually then keep rallying upwards. So yeah, so I mean, this shows how you can look at various forms of analysis. You can have looking at the 50 period moving average to see that we got picked up, and then you can see we did have quite a strong trend upwards after. I mean, a very strong move upwards after this. So you've got the formation, which you can look at, the chart formation. You've got the candlestick formations here. You can look at a doji here, a tweezer bottom. And then there is also a tool you can use which is called a Fibonacci retracement. So if we go from here, sorry, let me get this up. Here we go. If we go from here to here in this trend, you can see we actually get picked up on this move. We get picked up around the 382, basically the 382 extension, 382 retracement of this move. So what that shows us is that not that what that shows us, but this is something you will often see. The 382 is a typical level, Fibonacci level of retracement in an upwards trend. So if it's a strong upwards trend, the 382, because the 382 is not a deep retracement, you will often see retracements reaching the 618 level, which is here. But if we're in a strong uptrend and we're going to resume that uptrend, then you will often get picked up higher up than the 618, so at the 382. So you had quite a few points of convergence here on various indicators. You had the 382, you had the 50 period moving average, and the cup and handle formation, and then obviously you can see what happened after this. It was upwards and upwards quite a bit. So that's how you can use it in conjunction with chart formations and also candles. So if we want to look at another chart, you can use the 50, but I've been calling it 50 period, 50 day if you look on the daily chart. But if you want to look over here at a monthly chart, so obviously the higher you use it, or the higher time frame you use it, the more it can be of relevance, because it's taken into account more data. So here we have the 50 period moving average for Apple. So you can see this goes back to, this is 2008 here. So this is a good full 12 years, well, 12 years more of data. But what we can see, we can definitely see the relevance of this 50-month moving average. So there was a touch here, which was then picked up, and a touch here which was then picked up, a touch here that was then picked up, and a touch here that was then picked up. So obviously these are long-term trades. You're looking for big moves. If we get a price range tool, even from this one here to the top of there, that is a 742% gain, which is huge. And then if we then want to take, say, this one here, that's only 130 to 134. This is a log. Sorry, this is. So I messed the chart up a bit here. Sorry, we weren't in a logarithmic chart here. I was just gonna say we were in a logarithmic chart, but we actually weren't. And if you actually take the move from here to here, we're looking at 154% move. And then finally, if we look from here to this is where we are now. The price is going. This is 117% move. Let me just quickly do this again. So from here to here, 700% move. So you can definitely see the relevance on this time frame. So this is the monthly chart. The 50-month moving average is obviously of relevance. So you can use it. You can use it on the weekly chart as well, and then it would be a 50-week moving average. Something that I do want to show you guys, something that you can do, something that is of relevance, is that if you have here, this is a 50 period moving average on a daily chart. So say you also then want to overlay the 50-week moving average, so it's on this chart also, rather than clicking into the weekly and then obviously having the 50 period moving average on the weekly chart. You can actually overlay it on this one, and what you do is you just have to do a bit of simple maths. So if this is a daily chart, 50 weeks will be 50 times 7 days, so that will be 350 days. So then you will change the daily, the average, the moving average, exponential moving average on a daily chart to a 350 period. So then in effect, when we get that on, what we have here is the 50-week moving average on the daily chart. So that is just a helpful hint there for you. So that's looking at the 50 period average. So that's a 50-day period average and a 50-week period average. So now what we are going to look at is how we can basically, if we will break the 50 period moving average, the next the next major moving average people will look at is the 200 period moving average. So often you can be picked up by the 200 period moving average if you break the 50 period moving average, and you can sort of play a game of ping pong between the two. So what we're looking at here is Biogen. I'm just using this for illustration purposes. So you can see the 50 period. This is the 50 period moving average, and this is the 200 day. Let's call it day. We're on a daily chart. So this is the 50 day moving average, exponential moving average, and this is the 200 day exponential moving average. So what you can see is we are going up. The price is going up whilst we are sloping up on this 50 day moving average, but we do break it and break underneath. What you will often find, this is something you'll see when you look at charts, you'll often get a retest of the underside of the moving average, because what you get is you get an old support becomes new resistance. So it's an OSNR, old support, new resistance, basically touch. So we broke the moving average. We clearly got underneath it. We retested it, and then we sold off. And then look where we were picked up. We were picked up at the 200-day moving average, and then bounced off the 200-day moving average, back to the 50-day moving average, and then we were then rejected from the 50-day moving average again in its downward slope, but then picked up by the slightly upward sloping 200 period moving average. So obviously the 200 period moving average is a longer time frame moving average because it's a 200 day. So this is still moving up. So it still shows that in the larger time frame we are still in a bullish trend, even if on the shorter time frame we're in a downtrend. So we are getting squeezed between these two trends, as it were. I mean, these two moving averages are showing us two different trends. So we have the longer term 200-day trend and the shorter term 50-day trend, and they are squeezing the price, as you can see. Then we get picked up by the 200, rejected again by the 50, and then we go for the 50 again. We break through it. We then have, like we had the test of old support becoming new resistance, we have the old resistance becoming new support. So the OSNR one, old resistance becoming new support, and then we bounce off that again. We do come down again and test underneath. We don't make it all the way down to the 200 day, and then we gap up. We touch the 50 period again. As you can see, there is a relevance between how price can be squeezed and move between these 50 period and the 200 day, the 50 day and the 200 day moving average. So yeah, that was something that I did want to show you. So. And then finally, what we are going to look at is an actual crossing of the 50 period and the 200-day moving average, because these have a name. They're called a death cross and a golden cross. So what happens is, on here now we're looking at a long time frame chart. So this is a weekly chart of the S&P 500. So these are 50-week moving averages, and this is a 200-week moving average. So these are long-term charts. So what you see here, when the shorter period, so the 50 period, crosses over the 200 period or 200-week moving average, that is what's called a death cross. It is called a death cross when it is the 50 crossing the 200. And then you can call it say you've got the 50 period crossing 100 period, you can call that a bearish cross, but it's not. It's a special name given to the 50 period and the 100 period, and that special name is a death cross. If it's not the 50 and 200, it will be called just a bearish cross. So we have this death cross, and that is meant to signify then the start of an official bear trend based on these higher time frames. So as you can see, we have the crossover. You see price is relatively following quite well the 50 week. We break under the 50 week, which is the first signal that we are showing weakness in this trend. We can't break back over it. We then get the full-on bear cross here with the 200 period, and then price then does continue down, continuing down following the 50, getting rejected by the 50 period, and then we do finally regain the 50 period, and that signifies the start of a potentially, obviously we don't know until it happens, but potentially the start of a new bull trend. And then at this point here, this is called a golden cross now. So this is a golden cross, which is good for the bulls. And that is when the 50-week moving average crosses the 50-day moving average. Sorry, the 200-week moving average. And as you can see, we then go into a stronger bull trend. We have these moving averages diverging away from each other, which shows that we are in a strong uptrend. We've got good upwards movement, and we do keep on getting picked up by this 50-week moving average. So then we do convincingly break under it. We actually break under the 200 as well, so that's a pretty strong move to all come in one go. Literally the break of it, we are, if you zoom in here, you can see we are picked up relatively well. We don't spend more than the week. The candle closes back above it, apart from this bit here, but generally speaking, the majority of the price action is squashed between, like we were talking before, is squashed between the 200 and the 50-week moving average. We then get rejected by the 50 moving average with its downward slope, rejected by the 50 moving average, which we also spoke about before. If we're in a downward trend, the 50 period moving average is moving down, we'll often get rejected by it, and then we are basically retesting that old support of the 50 period moving average, testing it as new resistance, which it indeed is. We then get the actual bearish cross. The 50 period goes under, and then we enter obviously more of an extreme bear trend as the price moves quite far away from the 200 period moving average, 200 week moving average. So that shows that we make quite a big downward move. So then we manage to regain that 50 period moving average, and we have an upward slope, so that signifies the start of a bull trend. We do start to move up. We also regain the 200 period moving average, but we haven't got the bull cross yet, the golden cross. We sort of come down. We have obviously a few market jitters here. We sort of play around again, breaking under, holding under, getting back up again. So we do have a lot of indecision here, but indecision based around the 50 period moving average. Then we do convincingly break the 200 as well. We actually have the bull cross too. So it's then all systems go, back up again. But we do then have another downwards trend. We break the 50, break the 100. But I mean, the main thing I'm trying to show you here is that we have the bull cross here. And as of that point, it does signify the start of a bull trend. I mean, we do have some testing back underneath again, but that is relatively short-lived. I know these are weak candles, so this does go on for a good few weeks, but if you can see in the overall size of the price action, it's relatively short-lived. And then we do have a nice upward trend going on here, where we are usually supported by the 50 period. If we break the 50 period, we then get supported by the 200 period. We then rally back up, regain the 50 period, use the 50 period as support again, and then if we lose it, we get supported at the 200 period, supported from that straight back up to the 50 period, and then start using the 50 period, 50 week again, as support. So you can see by this chart, and this is like where we are right now, you can see by this that you would expect some sort of a return down to meet the 50 period, at least the 50 period moving average. Obviously we do know we can come all the way down to the 200 week moving average, but yeah, this is currently where we are in the SPY at the moment, in the S&P 500. So yeah, so there we have a good overview of the 50 period moving average, how it interrelates with the 200 period, how you can use it for trading, how you can use its slope analysis for trading. And then yeah, so thanks for listening, guys. I hope that was helpful. Please like and subscribe the channel. I have plenty more videos coming of all aspects of trading, coming from Dan's School of Trading. And remember, this is just for educational purposes. It's not financial advice. I'm not a financial advisor. And yeah, thank you for listening, guys.